Good afternoon, everybody. Welcome to our webcast on long options. I'm Connie Hill. Happy to be here with you today. It's a good day to be involved in the markets, and hope you're enjoying it. How many of you are familiar or maybe have used in the past something we call LEAPS option contracts? You might even just hear it referred to as a LEAPS contract. Go ahead, answer me in the chat. I want to get an idea of how many of you are familiar with this. It's something that has been requested that we talk about, and so I'm happy that we're going to dive into that today. Now, I am on X. I hope you're following me. Hope you're following Cameron as well. He's out in the chat. He's going to help field some questions maybe I can't get to. But he is Cameron May CS. I am Connie Hill CS, and we'll post educational content out in our X account. It's free for you to join, free to follow. You just get some little nuggets along the way that we put out as coaches, kind of some things that we're noticing in the market we'll share with you. Let's go through our disclosures and we'll get down to our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for information and education. Don't consider it a recommendation. We will be using the Paper Money software application. That's what you download to your computer. Looks a little bit different than the web version or mobile version. It is the most robust version of Thinkorswim, however. Past performance of any security or strategy does not guarantee future results or success. So keep that in mind. All right, now I'm going to look at my chat here real quick. See how many of you are familiar with LEAPS contracts or use them. All right, Kevin knows a little. Let's see. David has not used LEAPS. Yep, Buffett, I did a talk about them. Oh, interesting. Okay. Truth will always prevail, just giving us a high there. Mighty Mouse, you like using LEAPS options. Okay, Kevin says, maybe I think so, but maybe it's been a while since you've done that. Chris says, I've never done a LEAPS trade. Okay, well, we're going to get you exposed with that. Greg's a yes. Glad to see that some of you have some familiarity with them, because that's what we're really going to be talking about in great detail here today. So for our agenda, we always talk about different concepts of long options, because those are the only strategies we discuss in this class. So we just kind of dive in pretty deep to it. We typically, when we're talking about options, we're talking about the relationships of price, time, and volatility and how those influence an option price. And of course, we're going to do a lot of examples here today. So long options are typically considered directional trades, which means we need the stock to move. There are some trades that are neutral. The stock could maybe just go flat and it could still be a profitable trade. With a long option trade, you absolutely need the stock to move. And we're looking for it to do it in a period of time before that option expires, right? Because there's an expiration date on it. It is what we consider theta negative, which means time works against us, generally speaking, in all options. We're going to talk about LEAPS options, and they don't have the same type of decay element as, I'm going to say, as deep as a shorter dated option. We'll take a look at those theta values. They're considered vega positive, which means that when implied volatility changes, if it goes up, it helps the price of the option proportionally to go up. And if it goes down, then the price of that option could lose some value from that volatility as well. And when you're trading, the most you can risk is just your debit paid. Okay, whatever you put down for the contract, it could go to zero. And that really is your worst case scenario, is that you use it all, which is why it's so important for us to make sure we position size. All right. So price, time, volatility, we're going to talk about it as we pull up these different options. Now, a couple of things I want you to be aware of with LEAPS options. What makes a LEAPS option? Oops, let's go out to our Thinkorswim here. And just want to get just a general idea of what the market's doing, right? Still making higher highs, higher lows. NASDAQ hit a new high yesterday. SPX is up. So yeah, the market's down a little bit today, right? A little bit of pulling back. Maybe there's not a lot of news motivating the market right now. When that happens, we can kind of see it just sit sideways, consolidate, not move around a whole lot. Okay. Now, a LEAPS contract, we're going to look at our first example here, is going to be Kroger. Kroger's been in the news, right? Because it was looking to maybe combine with Albertsons, and they didn't allow that deal to go through. That news broke yesterday, and Kroger got a nice little pop on it today. Now, I know there's a little bickering going back and forth between Albertsons and Kroger, and that's not really our concern. All right. With a LEAPS contract, essentially, I'm going to tell you, LEAPS stands for long-term equity anticipation security. That's what the S is on the end, security. LEAPS is a whole lot easier to say than that mouthful of words, okay? But basically, it's just a longer dated option. We're going to come out here to the trade tab on Kroger. And to qualify as a LEAPS contract, there has to be at least 7 months of time in the contract. And many of them are dated January expiration. So as we look out here, and we see, all right, we've got some that'll be in 2025, right? This one, the September 19, is not necessarily going to be considered a LEAPS contract, even though it has more than 7 months worth of time, okay? But this January 16, expiring on the 20s in 2026, and this one expiring in 2027, those would be considered LEAP contracts. And you can see there's a ton of days here. So the reason people might be interested in doing it is maybe they want to have a long-term position in something, but they don't want to pay as much as it's going to cost if you were to buy the contracts or the 100 shares of the stock outright. All right, so we'll take a look at this. What are some pros and cons? Things you might be looking for first, actually, is you want to like the fundamentals of the stock. And in this class, we haven't dealt a lot with fundamentals. We've looked at a lot of technicals, because a lot of things we're doing are just short term. We're thinking we're going to be in and out in a couple of weeks. All right, so maybe sometimes a little bit longer. But these, we're planning on being in a long time. So you like it, you research that stock, you like that stock. One source that you can use here, if we come over to the Analyze tab, come over here to Fundamentals. Some people like to use analyst ratings. You might not want to exclusively rely on analyst ratings. You might want to go in if you have certain parameters for stocks that you like to hold longer term. You want to basically use those parameters, okay? One of which could be, what do analysts think? Now on Kroger, we're seeing a lot of green from these analysts. Doesn't mean it's a shoe-in, going to do the best thing for us, right? But at least we have an idea of what analysts are thinking of it. You can come down here, and those of you that like to do some numbers crunching, all right? You can come through, look at some of their ratios. Maybe you like companies with a certain PE ratio and you would want to maintain that in a longer term option contract. All right, so you want to do your due diligence, which means taking some time with the fundamentals, making sure it's a stock you're really quite interested in. All right, so let's take the case of Kroger here. And we're going to go to the trade tab, and we're going to look on Kroger. We're going to go out to the January 16th, 2026. Okay, so we've got a little over a year in these contracts before they would expire. So we've got about 400 days. And that might seem like an eternity if you're just usually trading something that expires 30 days and less. And you're thinking 400 days, that's a long time. And so the mentality for this type of an option trade is different. Now, if we were going to maybe put in a target for Kroger, okay, I drew in this channel where it's been trading here recently. Today it popped up and kind of popped outside the channel area. I want to show you a little bit longer term chart here. We're going to go out to 5 years so we can kind of see, well, what has the stock done? And right now, sitting at some 52-week highs. This is actually a 5-year chart, so we're seeing it, is at a 5-year. And I believe this is actually an all-time high on this. So we might say, well, where do we think it could go to? Where might we project it to go? You can see where it broke out was right here about that 62, 63 resistance area. We zoom back into a shorter frame chart. What we're going to see is it gapped just kind of like it's sitting there on the support. Now, it could do one of a couple things. It could drop back down into the channel. One thing that I think is interesting, especially on this stock, is on the channel here, notice how often the stock kind of uses that midpoint of the channel as support and resistance. Okay, we can see support through there. Oh, look, resistance through there. This one, it came down to the bottom there. So sometimes it will use it, sometimes it doesn't. So our expectation might be, okay, maybe it drops back down into the channel. Maybe it stops at halfway, who knows? Or maybe it starts a steeper new angle of ascent, right? Maybe it starts out doing something a little bit higher here. So time will tell what exactly it does. All right. Then again, it could totally reverse on it. We really don't know. But you're going to do it on something you have reason to believe is bullish and have reason to think that it could continue. All right. Check something here as far as your questions go. I think Cameron might be handling them just fine, but I do want to do just a double check in here. All right. Yes, Cameron, thank you for helping me out on those questions. Appreciate that. Okay. Now, which one might we go look at? Okay, if let me go back to the chart. Some people might pick a target that's a little bit out of the money or something that's way out of the money. Now, I put in some projection room for this channel because I wanted to say, okay, if it just were to continue at its pace that it's at right now, where's a realistic target? Maybe not necessarily by the time the option expires, but maybe in the next 6 months, next 4 months, 6 months, even though we're expecting to stay in the stock longer. This is how some people might choose a strike price. So we can come up here and we can see, well, right, you know, it got up to 63 right now, you know, would 66 or 68 or even 70, somebody could consider going out of the money. The further out of the money you go, the longer that stock really needs to travel in order to start gaining intrinsic value. So we're trying to balance that a little bit. So if we come over here to the trade tab, we are going to use these options that have 400 days. We are going to go a little bit out of the money. We're not going to go huge out of the money here. We are just going to do the 65 strike price. Now this 65, let me get my columns back here. Let's do this one. This is our delta column right here. So if we're coming out here to 65, it's about a 54 delta. That means for every dollar the stock continues to or goes up in value, we expect it to increment 54 cents, at least on the first dollar. And then the gamma value kicks in, right, on the second and third and fourth dollar. Some people, if they want to be more conservative in this approach, they might start here in a higher delta. We're not going to because we want leverage to work for us a bit. Now, don't accept the same, expect the same type of leverage on a long-term option that you get with a short-term option, okay? Because on a short-term option, you might get incredible leverage. Maybe the stock moves $5, but your option moves 50% or something. If that in that same stock, and you can go through and use the Theo calculator for this, you'll see that these options go up in value as well, but not quite to the same extent. Okay, let's look here at the Greeks. We're going to do our delta, gamma, theta, vega. And I want you to notice here the theta value. Okay, theta is how much is it decaying for every single day. That day includes holidays, it includes weekends. And so these options are decaying a penny. Penny on the call side, and let's see, kind of a penny or less on the put side. Okay, very little. What if we were to compare that to an option that just has, say, 36 days? We'll go with these monthlies here. What is the theta value here? Well, it's double. Okay, and sometimes as you get even closer, you'll see that value pick up. Notice here, these are now 5 cents, 4 cents. So the closer you get to options expiration, the higher the heat is on that time decay. So that's one thing to be thinking of is, gee, if I've got a lot of time, we don't have to worry so much about theta decay as much. It's still going to happen, still going to influence it, but not to the extent as if you were doing a short-term trade. Now, if we went to go ahead, let me get back my column here that shows the delta an open interest, you want to make sure you're looking at a stock that does a lot of trading. Look for oodles of open interest. Okay, you can see we've got thousands out here. Some people have already had this idea of maybe trading these options. Okay, we're going to go with the 65s. They have plenty of open interest. Don't solely pick your strike price based on open interest, but just make sure they're sufficient for what you're doing there. Contract, nice narrow bid-ask spread, which happens when the stock is very efficient in its options because there's a lot of trading activity there. So this is going to run us about $6.50. We might be able to get it at the midpoint price here, but let's just say $6.50 for the moment, which translates to about $650. Now, it gives us the right to control 100 shares of stock, and we're trying to do it as a stock substitute, but we don't have stock ownership rights. Options just don't, okay? So you have to know you wouldn't be eligible for a dividend. You would have to know that it may or may not have, even though the stock may have voting rights, you won't have voting rights with an option, okay? Your main purpose here is to see if you can get some decent leverage with an expectation in a stock that you like, that you wouldn't mind just doing it for option price. Okay, so one contract would be about $650. If we were to buy 100 shares of Kroger right now, we're going to be paying over $6,000. Okay, so you're saying, oh, that's significantly different, 650 versus 6,300. Okay, all right. Now, we are going to try to track these trades for a while. That would be the intent here, okay? So we're going to go ahead, let's see, it gave us a little bit lower price. All right, we might even be able to get it for $6.40. We're just going to do one strike price. We're going to hit confirm and send. We're going to send it on its way. And if you want, you could put a stop loss on it. Many people might not do that, but they'll keep an eye on it, right? With leaps, because we're hoping to run the peak and the pullback and the peak and the pullback, our timing is not so, it doesn't have to be so impeccable, is what I'm going to say, okay? Could you still find an entry point you like you like to do with stocks? Absolutely. This one would be basically that it's having a nice breakout here, okay? And it looks like it may stay there. Again, we talked about how it could dip down, could reverse on us, we don't know. All right. But you don't have to be so impeccable. If we're, say, a day late or 2 days late on an entry we like on a short-term option, and we miss the window and the stock's already moved, 8-10%, we might go, hold my horses here, not going to do that. With something that's longer term, you don't have to be so picky about that entry. Personally, I still like to do some better entries, things that I qualify on my rules as an entry, things that you're used to, breakouts, bounces, breakout from patterns, and so forth. All right, Chris says, how much do the option prices this far out fluctuate? Would it make sense to do a GTC limit order and let it work for a while to get a good price? You could if you wanted to. Okay, if you said I don't want to pay more than, say in this case, $5 for the option when it was costing us, a little over $6, you could do that. But if you've already got an entry signal you like, then you might not be doing yourself any favors to actually miss the trade because you wanted to wait for it to pull back in price. What you'll notice is that it will vacillate when the price of the stock moves, just not to the same degree as our shorter term options. Okay, it's kind of like having I was going to say a rubber band. There's some fluctuation in price there, but it's not super extreme. Okay, but you obviously still get a lot of leverage. We're purchasing something here for $640. I think we got it for $640, and we're going to take our time. We're not going to be rushed. All right, let's look at another example we might consider using. All right, when COVID was going on, so many of the travel stocks just really took a hit, right? And now the airlines are recovering, cruise lines are recovering. We're going to look at a stock here that is kind of like back on the path. Okay, this is Carnival Cruise Line. You can see up here in my kind of these red labels, year to date, it's up 42.2%. It's not the cruise line that's up the absolute most, but I want you to look at this pattern with me. We're going to go out here about 5 years, and I want you to see where the stock was before the big old sell-off. Okay, before COVID hit here in 2020, right? And it took this major drop, you know, it was up here to as a $51 stock. So you might say, okay, well, now that maybe that industry is a lot more healthy than it has been in a while, maybe there really is some upside potential here that somebody might want to target for, okay? And patiently allow the stock to get there. Now, what we're looking at here is interesting because it did break through some nice resistance here about 19, and then you can see it's continued to run. Next area of resistance might be up here about 31, but in this kind of a trade, we're planning to hold through earnings. We're planning to hold it longer term. As long as that trend stays intact, we're going to stay in it. Now, we're not going to say, oh, it broke support by 50 cents, so we got to get out of it, okay? We're going to be very liberal as far as the kind of movement we want to allow the stock. All right. Let's see here. Yeah, Cameron, thanks for helping me out here answering some of these questions. All right. Let me go back and check Sharon's question here, because I think there's a follow-up here to Sharon's question. And let me see where Sharon was. Sharon says, can you also sell the call along the way? Absolutely. If you want to combine strategies here, that is something people will definitely consider. Okay, so what Sharon's talking about here is, okay, so we buy this longer dated option. Let's go see about Carnival Cruise Line. They've traded 9.7 million shares. We're also going to look at these January options. And so, yeah, you might say, in this case, we're going to go for the 30 strike price. Make sure I'm doing the right one. Yeah, we're going to pay about, yeah, $390, $400 for this option. But yes, could you consider selling shorter dated options, you know, out here in some of these expirations? Absolutely. What would that do? Well, it could help you lower your net debit, right? Pay $6 for it. Maybe you sell a contract out here that has 30 days and you sell it out of the money, out of the money, you might be able to start reducing your cost basis a little bit. So yeah, you certainly can combine. Because our class is only long options, Connie doesn't get to combine strategies, okay? But you certainly could consider it, and I think that's a reasonable expectation, all right? One thing I noticed as I was out trying to find Sharon's question, it looks like we have a survey out in the chat. And you guys know from time to time, we'll kind of take your pulse and see what you're thinking. So we always appreciate it when you take the time to fill out that option or that survey for us. 2 questions, you just fill in the radio button, what you feel like on a scale of 1 to 10. Then there's some questions you can answer, 2 questions if you want. And also I encourage you to use it as room to communicate something with me that you would like to see possibly in a future class, okay? Or, hey, I'm struggling with this concept. Could we weave that in to an upcoming class? And absolutely, that would be just fine to do. Also, if you have questions, maybe after a class is over, feel free to hit me up in the notes and say, hey, go down to the comments section and ask your question there. That's for anybody that's here live as well as those that are listening to this on a recording. All right, so we are going to, on this one, again, we might pick something a little bit out of the money that we think maybe is a reasonable target in a 3 or 4 month period of time. Again, somebody wanting to be more conservative could go a little deeper in the money. And the idea with this as far as management goes is when the delta creeps up, say the stock does what we want it to, and the delta starts incrementing and maybe it starts getting in the 0.9 deltas, okay? You might say, I like the trade. I want to continue the trade, but I've lost some of my leverage because it's so deep in the money now. And so you might roll it out. Okay, what might you roll it out to? It kind of depends on when you're doing it. And if you still want to treat it like that longer term stock positioning, okay, you could maybe sell a different strike price of the Januaries that expire in 26. You might even come out here to the Januaries in 27, or even these December options of that year, 26, okay? And you could do what we say is rolling, which basically is selling the one contract, buying the next one, okay? And people that are actively doing that may roll that contract a certain number of times, as long as the trade is still doing what you want it to do. All right, so on this one, we're going to do the 30 strike. It's a little bit cheaper of an option than the first one was. Same thing, we'd find the theta is incredibly low here compared to something that's expiring sooner. Okay, so we've got about 390 here. In this case, we could do a couple contracts. All right. Typically, we don't want to risk a lot in this account, but we can do 2 contracts here without a problem. Okay, we're going to put it in. Now, 30, how soon could it maybe possibly get to 30? Well, 30 would be before this area of resistance. If somebody wanted to, and sometimes people do this, they'll choose their strike price based on, well, where do I think the stock might get to in the next little bit of time? Okay, not next week or in 2 weeks, but more like months versus weeks. Okay, so somebody could choose 30, which we're doing. Somebody might like 35. They had a 32.50. Some people might entertain that. All right, but we're just going to do the 30 right here. And of course, you can see there's options, strike prices further out. All right, if we were doing this in a longer term type portfolio, we would still want to monitor it. We would still want to check on it. We're not going to go too wild over monitoring it in the sense of you don't need to look at it several times a day, more likely than not, okay? But, you're going to let it weather the ups and the downs. Oh, a little piece of bad news. Oh, the stock pulled back. Oh, okay, well, we get another day, the stock's back up, after that pullback or whatever the case may be, without getting overly involved, feeling like you have to watch it every step type of a thing, versus something that's maybe you're hoping makes a move in 3 days. You'll be watching that one a little bit more closely. All right, we're going to send this off. What is this letting us say? Just saying this could be a contract that is put in a concentrated position, and concentrated positions may result in higher margin requirements. We're buying the option here. So we're not planning to use any margin. Let's go ahead. We're going to submit this. All right. I want to do a couple of things here. One, we're going to take a break from trading, and I want to introduce you to some new things that are going to come out in January. Okay. First of all is this particular class, long options. The time is going to move to Tuesdays, and it'll be at 1 Eastern time. Okay, so here we're Thursday at 3 Eastern time. This is going to be Tuesdays at 1 Eastern time, and Brent Morse is going to lead the discussion. Okay, if I were continuing, I would keep these in a longer term portfolio, or keep them in. I wouldn't wipe the positions out so that we could monitor a longer term position. And then in this slot, this exact time spot, we'll be getting started with stock investing. And so that's going to bump to a Thursday afternoon. That'll be 3 Eastern, this exact time slot. Okay, so I want you to be aware of those. I also want to show you some of the cool classes that are coming up here. I'm going to go over to Schwab.com. I've logged in, I've come to learn, and I've come to the live webcasts and workshops. Okay, and here is our calendar in January. So on, let's see here, swing trading is going to be something new. And where is it? Right here, 3 p.m. on Tuesdays. Mike Fairborn's going to teach that class. The next day, we have trading index options. Okay, this is going to be an exciting class. Ben Watson's going to lead. These are some topics we've wanted to be able to get into, maybe kind of spread out your understanding of all the different ways you can use options. Okay, so Ben will be teaching that class. We'll also have Barbara Armstrong is going to teach a class, trading price patterns. So we're kind of combining trading flag patterns and breakout patterns to any pattern, okay, in that particular class. That'll be nice. And then we have this new class here, after hours trading. And on after hours trading, it's designed for those who maybe can't join in on the day, can't join us during the day. Maybe they're working and they can do it in their after hours. And so things that would be specific to that kind of person. And then the very last one, last class on Friday is going to be called Market Movers. And Ben's going to lead that discussion as well, as far as, you know, what's happening in the market, what should we expect in the market, what do we need to be looking out for during the week ahead. All right, we think those are going to be some really nice changes to our offering. Okay, so just want you to be aware of those things. Now I need to do a little bit of follow-up on something. I want to follow up on our trades that we did last week. Let's go through those, and if I'm efficient with my time, I think we might be able to sneak in one more Leaps contract trade. Okay, so out to the monitor tab we go, and I'm going to open up my watch list here. In long options, the only thing we had previous to our starting, now we've got our CCL, it looks like. What is one trade on Rocket Lab? Now this, we bought 2 contracts, January expiration, so we still have 36 days on it. We put in an initial stop loss on this stock at half of its option price. So we've got our stop loss sitting in there, and it hasn't triggered, okay? But it has gone down in value. Earlier today, it was about $3. We bought it for $3.60. It looks like it's dropped a little bit more now. It might be getting close to hitting our stop loss. Let's take a quick look. Rocket Lab. And let's look at, just say, the last 6 months here. And we'll zoom in. All right, we just got in these last week. And we had seen this long run up, then this nice little pullback, and then it looked like it was just bouncing here ever so nicely. Okay, has it done a lot? No. When it was up earlier today, and it was down maybe 50 cents in the option contract, it's like, it's not so bad. But now that it's pulled back a little bit more, and if it were to continue to pull back a little bit more, would start to feel the time decay. Now, one rule that you can use on these shorter term trades is if the stock hasn't moved half the amount that you thought that it would in half the period of time you thought that it would take, that might be a time to consider getting out. Okay, we're going to give this we're going to let it trade Monday if it doesn't hit our stop, or I should say through Monday. We're going to look for some good movement in this, and if it doesn't by next Monday, that probably is going to meet that rule. Yeah, that it's just not moving right now. We don't want time decay to bother us anymore and devalue the price of the option, so we'd go ahead and get out. Now, some of our other trades that we did last week, we are out. Yeah, so let's go to another one that we did here. Let's go to IONC. Let's take a look at the chart first, and then we'll go look at numbers. IONQ. All right. This stock has been just a big mover. You can see year-to-date change, 139. It's like pants on fire. But maybe it's starting to slow down here a little bit. We got in on this nice little bounce. Okay. This is the day we got in, ran up the next day. Then it started to pull back. We had adjusted our stop here. No, we didn't. Let me come over here to the monitor tab. This particular one, let's go over here, hit our original stop loss. So it didn't move enough really to move the stop loss up. With that, the next day it went up a little bit, but nothing real meaningful. And so we got stopped out on just our initial stop loss, which we had put at about 50%. One thing I want you to notice here is that our trigger price was 315. And you know how we say, we're hoping to get filled at something close to that, but that price can't be guaranteed. Our fill price on it was 305. And I think that's kind of a typical thing you might see, is that it's sort of close to it. And that's our intent, is to get sort of close to it. So this one ended up in being basically a 51% loss when you work out the numbers. Now, I want you to see this one, CRDO. Credo. And on Credo, we were able to move the stop loss up. Okay, so we bought the 65 call. We bought it for $9. We had a stop loss in here that we canceled. Okay, what was it? Well, it was our original stop that said, hey, if the stock goes to 63.80, get us out. And then the next day, we adjusted that stop again. We said, all right, if the stock drops below 69.90, then get us out. And that's what happened that next day. Had a pretty steep pullback. We'll look at the chart just real quick. Let's link this up here. Get it over there. And so you can see we got in fabulous earnings. People were excited, lots of volume moving in. So we moved up our stop loss here. Sure enough, took a big drop down and stopped us out. We ended up on this particular one just getting filled, you could see, at our break-even point. Okay, so we paid $8.95 and we got filled, I guess, a little bit better, $8.85. Okay, we got a whole 10 cents. No, we lost a whole 10 cents on that one. Okay, so kind of a wash type of trade. Our KLB, we already talked about, we're going to allow it to continue to work, continue to move. The other one that we did here was on PLTR. And on PLTR, we were able to move the stop loss up. You can see here, we had our original one. We canceled it. And then again, on this day that had a decent pullback, we got filled on it. And you can see we made a teeny bit of money. Nothing to really write home about, but better than a break even and better than a loss. And really, it was because we were active by moving up that stop loss. Okay? So it's always good, I think, to review what happened in your trades and learn from them. And again, it was just this big pullback day, ran up high and then pulled back. And so, again, it's better to get out with something rather than nothing or having a loss. Okay. The approach we're looking at, these long-term LEAPS contracts, completely different. Okay, we're going to look at one last one here that I'd like to do. And this one, I'm going to say, might be considered more value type of play. Okay, have you been following Boeing over the last few years and kind of seen some disappointment? Okay, one, you would have to be liking the fundamentals of Boeing. And if we come over here to the Analyze tab, we're going to kind of see a mixed bag. CFRA, very low. So that's why I say we've got kind of a mixed bag. So somebody, if they liked value stocks, they might consider this for a value purchase. But not everybody's going to be convinced of this, right? On this 5-year chart, we can see, man, it's just probably starting to recover. Okay, like just barely starting to recover as we look at this weekly candle. All right, so what could we consider doing? It's broken through this resistance here, and so short term, we're starting to see the higher peaks, the higher troughs, a little bit of recovery. You know, maybe its next area that it might maybe have a target to use around maybe 177. Let's come over to the trade tab and let's see what we were looking at here. Now on this one, we would look at doing these January 16s in 2026 as well. It's an expensive stock still. You know, it's $167. So if we were to buy 100 shares, we're talking about putting in $16,000 into the trade. If we buy one contract that controls 100 shares, right, then we would be putting in less. One we're looking at to do here is to do maybe like this 190 call. Now that's still a pretty expensive option contract, right? We'd end up paying $2,080 for this. But you can see lots of open interest. Boeing has lots of trading activity. Again, the outlook on this would be more, hey, is this really recovering? Are we thinking it's at a good valuation, a good value, that we would be interested in giving it, having some patience and allowing it to recover up to that time? Okay, getting back to maybe some previous trading levels. Never guaranteed to go there, right? None of these are. And so I wanted you to know the outlook on this is completely different than, say, Kroger that we looked at initially. But on here, I was saying, let's do the 190s, which is out of the money a little bit. It's about a 50 delta. And we're going to go ahead. Let's see if we can get filled at the midpoint price. We'll hit confirm and send and put this in our long options bucket. All right. We're going to follow up on this trade. Well, we'll follow up on all these trades next week and see just kind of where they are, see if their values have increased much based on what the price of the stock has done. If you want to do any what if experimentations with it, remember you can come over here to the Theo price calculator. All right. If you've got it selected as a column, then you can bring up the calculator, and you can even say, what do we think this might look like in June? Right? Bring up June and maybe just choose the June monthly. So go to the 21st of June. And then, you put in your what if. What if it does indeed go up, say to 190 by then? Okay. Increasing the value of the stock in the calculator, or the price in the calculator. 190, it's at 167 right now. So what about a $23 move? You could go ahead and plug it in. Plus, what did I say that needed to be? 190. So 23. Say a $23 move-ish would take it about to 190. And then you go back and you can check your values and see it doesn't make sense to do something like that. If it got up to our 190 strike price, it looks like the value would be roughly 23.80. Now, that's where I'm saying the leverage that you get in these longer term options is not as, this increase is not going to be as maybe leveraged as much or getting as big of an impact as something that's shorter term dated, but your approach is completely different. And your idea of wanting to do something longer term without committing as much capital to it by going the option route, the LEAPS contract route versus the stock. Are they structured the same? Is their anatomy the same as any other? Absolutely. Okay, just know they just have a lot of time associated with it. All right, Cameron, you had to answer a lot of questions today. Let's see, Kurt saying when I was showing the chart for Rocket Lab, there was a red horizontal line that showed the stop loss that I had entered. It was actually based on the price of the stock, I believe, on that one. All right. Oh, okay. Cameron's letting you know how we did that. Very good. How many of you feel a little bit more comfortable about LEAP options? How many of you feel like, oh, I know what a LEAPS option is now? When people talk about it, I just know it's a longer term option, right? That has to have at least 7 months, and you can purchase out there years ahead. And yes, as Sharon brought up, could you consider selling contracts against it, maybe diagonalize the trade? Absolutely. Since that's not our topic, we don't go into it, but you absolutely could. All right, you guys, appreciate being here today. If you wouldn't mind filling out that survey, we always appreciate it when you take the time to do that. And again, if there's something you want to communicate to me to say, hey, let's cover this, maybe next week or the following, these are some things that maybe I would like some assistance with. I love to incorporate those type of things into our webcast. All right. Coming up next, I believe it's going to be getting to know Schwab.com. Brent Moores is going to lead that discussion, so we'll come back at the top of the hour and get going then. Hey, have a good afternoon, everyone. We'll see you next week as we follow up on these trades. See you then. Bye-bye.